So today we have to discuss the contract modification under IFRS 15. Clear? Okay. So what does we means by the contract modification? Let me explain it here. Okay. Here. Contract modification. Okay. So when you have a contract and the contract is changed, okay, and this change is because of scope of the contract or price of the contract, then we call this is modification of the contract. So when you have modification of contract, then how you will account for? So you have three scenarios. Let me write here. This is the modification accounted for. The first one, you will treat the modification as a separate contract, or you may treat the modification as the termination of the original contract, termination of the original or existing contract, and creation of new contract. And the third one, you may count it as a part of the existing or the original contract. Clear? So in which case do you will count it as a separate contract? For that you have to understand that if the criteria meet like the scope of the contract increase because of adding distinct goods or services, and the price increase reflect the stand-alone selling price of those goods or services, then we will treat such a modification as a separate contract. Clear? So when you will treat modification as a separate contract, when you are adding distinct goods or services at their standalone selling price. For example, you have contract of 100 chairs, and now you have modified the contract with the 5 50 tables, further 50 tables, and these 50 tables definitely is distinct. So this means that this contract will be your separate contract. Such a modification will be treated as a separate contract. Now you must understand that what does we mean by the distinct goods services, and we have already studied this before, but let me recap it. Distinct goods and services. So if both criteria met, then we will call that the goods or services are distinct. The first one, that they are capable of being sold separately. Okay, means that the customer can benefit from it on its own or together with other readily available resources. This is the first criterion for the distinguished services. The second criteria, which we have already discussed, that it should be separately identifiable, and the contract, what does it mean? It means that the goods or services is not highly interrelated, or you may say like interdependent with other goods or services and the contract. And these criteria met, then we will say that the goods or services are distinct goods or services. Now when the goods or services are distinct and this increase the scope and the price, and with the price reflect the external sale price of those goods and services, then we will count such a modification as a separate contract. Clear? Now what if let me change the color here. This is called termination of the existing contract or creation of the new contract. So when the remaining goods or services, let's say we have a contract, we have transferred some goods, and there are and then after transferring some goods we have modified the contract, and the remaining goods or services are distinct. Okay, so when the remaining goods or services are distinct from what already delivered, then such a contract, in such a case, the old contract ends, mean the old contract will be terminated and the new contract start. Clear? Okay. So when the remaining goods or services, okay, are distinct from those already transferred, or you may say delivered. then in such a case the modification should be treated as a termination of the original or the existing, determination of existing contract, and creation of new contract. Clear? Okay. And the creation of new contract will be dealt like here, how you will deal that sort of contract. So you will do like this, that the remaining unrecognized transaction price from original contract. Clear? And additional consideration promised from modification, after modification. Let me explain it in more detail here. So what do you do? First you have to calculate the unrecognized transaction, unrecognized, or you may say unrecognized transaction price. You have to calculate this, and for that what do? You have to take the original total contract price and the revenue recognized to date. Let's say the total original contract price is 1000, and the revenue you have recognized for the goods services you have delivered before modification is 600. Then your unrecognized transaction price will be 400. Clear? Now after doing this you will have to calculate the new transaction price. Okay, the new transaction price, how you will calculate the new transaction price is very simple. You have to add the unrecognized transaction price with the additional consideration from the modified contract. So this is actually the accounting step that you have to follow. Let me write here. So the new transaction price will be, I think you know that you have calculated the unrecognized transaction price. So I will write you unrecognized transaction price plus additional consideration from modification. After modification you may say like this. Clear? Okay. After doing this you have to calculate the total units remaining. This will be equal to the units remaining from original contract, plus additional unit promise after modification. Clear? Then at the end you will here step number 4 will be revise price per unit. Clear? And for that what you will do, you have just to divide the new transaction price by total remaining units, and that will be your revised price per unit. So revenue for the future obligation will be calculated by the revised price per unit. So you have to follow these 4 steps. Let me here. Okay, I think it's maybe more page 0. Okay, now you see here what we did first. First you will do okay, first you understand that when the contract is not when the modification is not treated as separate contract, then it will be treated as a termination of the existing contract and creation of new contract. For the creation of new contract, you have to follow 5 steps or you may say 4 steps. And first what you will do, first you have to calculate the unrecognized transaction price. Let me write it again here. It has been written here. You see, okay. You see. First, what you will do, you have to calculate the unrecognized transaction price. And the unrecognized transaction price means that the original contract price less the revenue recognized to date. To date means the modification date. Then after doing this, you will have to calculate the new transaction price. Okay, first you have calculate the unrecognized transaction price, then you have to calculate the new transaction price. Okay, fine. The new transaction price will be the unrecognized transaction price, this amount plus the additional consideration from modification. Clear? After doing this, you have to calculate the total remaining units. Okay, total remaining units means that the remaining unit from the original contract, and additional unit promised. Clear? And then you have to calculate the revised price per unit, and this will be calculated the new transaction price divided by the total remaining units, and then you will get a revised price per unit. After doing this, then revenue recognized per unit, and this will be the revised per unit. Okay, clear? Now let's move on. We have if the good or services, if the modification is not treated as a separate contract, and the good or services, the remaining good or services are not distinct, then it will be considered as a part of the original then that modification will be considered as a part of the original contract. Clear? So for that, the remaining goods or services, if the remaining goods or services are not distinct, remaining goods and services are not distinct, then what do you do? They actually form part of a single PO, personal obligation. So the modification in fact will be modification impact. It will be it doesn't create a new contract, the first one, and it adjusts the original contract to include the revised scope and price. Clear? And the accounting treatment for such a modification will be that the transaction price, let me create space, it will be okay here. So the accounting treatment will be the transaction price and the progress. Transaction price and progress toward completion are updated to reflect the modification. Okay, so the transaction price and the progress toward the completion will be updated. And why we are updating? Because to reflect the modification. Clear? Now the cumulative revenue recognized is adjusted at the date of modification, and that will be based on revised total transaction price and the updated stage of completion. Clear? So we have studied the transaction price and the progress toward the completion are updated, and why we are updating this to reflect the modification, and the cumulative revenue recognized is adjusted at the date of modification based on the revised total transaction price and the updated stage completion. Okay, so the revised total transaction price will be equal to original contract price, clear, plus additional consideration from modification. Clear? And the second one which we have discussed, that is updated stage of completion. And for that, what do you will do? Stage of completion, we have already discussed this before, that cost anchored to date divided by the total estimated cost. Okay, total estimated cost after modification. Then you will get a percentage and that will be updated stage of completion. Now the third step you will do, you have to adjust the cumulative revenue to date. So your cumulative revenue to date will be is equal to revised transaction price multiplied with the stage completion. So when you are doing this, then you will get the revenue adjust. And this will be cumulative revenue less revenue already recognized. Okay, so we have discussed, like 1 minute I will reduce. Okay, so we have discussed that when there is a change in the scope and the price, then we call that is modification. Okay, and when the modification when there's modification in contract modification, then you will have three scenarios, three outcome. The first one is it may be treated as a separate contract, it may be treated as a termination of the existing contract and the creation of new contract, and it may be a part of the original contract. For all these three, we have discussed that if the scope increase, adding distinct goods and services, and the price increase reflects 10 alone selling price, then we will count that as a separate contract. Clear? And what does we mean by this distinct goods and services? Distinct goods and services means that if both the criteria mean that are capable of being sold separately, the customer can benefit from it on its own or together with the other readily available resources. And the second criterion is separately identifiable in the contract. So goods or services is highly interrelated and interdependent, not highly interrelated or interdependent with one with other goods services in the contract. Then we call that this is distinct goods services. Now if the remaining goods are services after modification, the remaining goods services are distinct, then you will have to terminate the existing contract and create a new contract. And for that, you have to do the remaining goods services. The remaining goods services. For that, you have. Let me zoom it. You see here. So the termination of the existing contract and the creation of new contracts. So the remaining goods services are distinct from those you have transferred before the modification. The transaction price for this new contract will be the total unrecognized transaction price plus the additional consideration. Now the unrecognized transaction price calculated by the original total transaction contract price less the revenue recognized to the date of modification. Once you recognize that amount, then you will add the unrecognized transaction price with the additional consideration of modification. Then you will have new transaction price, and then you have to calculate the remaining units, mean the units which are left from the previous contract, and the additional units which you will you have promised after modification. You will just add up these two types of unit before and after modification, the remaining unit before the contract modification, and the new units after modification, and then you will divide the new transaction price with the total remaining units, then you will get a revised price, and that revised price is your revenue. That will be your revenue. Clear? Now, if the goods or services are not distinct, the remaining goods services are not distinct, then that will be considered as a part of the original contract. And for that, you have some modification. In fact, will be that you don't have to create the new contract. You have to adjust the original contract. You have to include the revised scope in price, and for that you have to do the accounting treatment. The accounting treatment, you have to calculate the transaction price and the progress toward the completion. We have all discussed all these things. Now let's move on to the text, and then there we will discuss what actually we have studied here. Now you see here the contract modification refer to the change refer to the change. Let me here. Okay, change and the scopes or price of the contract. So when there is a change in the scope and the price of the contract, then we will call its modification of contract. And we have three types of scenario. That various reasons such as changing in the nature of deliverable or adjusting the term of the payment. So regardless how we account for these term modification based on whether the modification visit the creation of new contract or is treated as a part of the original contract. So when you will have the modification as a separate contract, when you will have that modification as a separate contract, for that, when the contract is accounted for a separate contract, if the scope of the contract increases due to the addition of distinct goods or services. When you have the additional this scope increase because of the distinct goods or services, and the price increases, the price is the amount reflecting the stand-alone selling price of these additional goods services, then if this criteria fulfilled, then you will treat the modification as a separate contract. Clear? You will count this as a separate contract. Now, if these conditions are met, the modification is treated as a separate contract and the revenue associated with modification is recognized as a new transaction. Clear? Now, if modification is termination of the original contract and the creation of new contract, then when this will happen, if the modification does not meet the criteria for being separate contract, the modification is treated as a termination of the existing contract and the creation of new contract. Clear? So modification is a termination of the existing contract and the creation of new contract. So that will be the case if the remaining goods or services to be transferred after modification are distinct from those transferred before modification, and the transaction price will be recognized that the new contract for the new contract is the total unrecognized consideration, and you will add the additional consideration promise, and then you will have the new transaction price. Clear? And for that we have followed the fourth step, that how you will calculate. We have discussed in every detail. Now after the third scenario, after this you have the third scenario. If the goods or services, the remaining goods or services are not distinct, then what do you do? Then that sort of modification will be considered as a part of the original contract. So this means that if the remaining goods or services after modification are not distinct from those transferred before the modification, they form part of the original performance obligation, and the modification is accounted for as the original contract. The modification will impact the contract price and the stage completion, and the cumulative revenue recognized should be adjusted at the modification date based on the new transaction price and the remaining progress toward completing the performance obligation. Clear? So Actually, what are the theme of this topic is that when modification occur, and this modification of the contract, then you have the first scenario that is separate. You have to treat that modification as separate contract, and you may treat that as to terminate the original contract and create new contract, or it may be part of original contract. Okay, for separate contract is this, you have to adding the distinct, mean the modification adding distinct goods or services at this stand-alone selling price, and that will be treated as a new contract. For terminate a new contract, that remaining goods or services are distinct from what already delivered, and the old contract will end and the new contract will start. And a part of original contract, this will when the new when goods or services are not distinct, and adjust the price and the revenue of the original contract. Okay, we have here some example I will show you here. Here, a separate contract, when you are dealing, it's a separate contract. You see here, if a customer originally ordered 100 unit of product and the contract modification add 20 more units are distinct from the original order, the modification is treated as a separate contract. So the original contract was this, and this modification of 20 more, so both are distinct goods or services, and that should be treated as a separate contract. Clear? So the price per additional unit is based on this 10 alone selling price. Now termination in the new contract, if the customer orders a specific set of product, and after modification the scope changed significantly and the product specification changed and the item become entirely different, the modification is treated as termination of the original contract and the creation of new one. Okay, because the good or service after modification you are receiving are distinct, so you will treat it as a termination of the original contract and the creation of new contract, and for that you have to calculate the new transition price. Now if the customer order service certain scope and contractual modification add more services that are not distinct. So when they are not distinct, then you have to treat that modification as part of the original contract. So extra support or maintenance that is closely related to original services, it means that the good services are not distinct and the modification is treated as a part of the original contract. So the transition was adjusted to reflect the changes and cumulative revenue as updated accordingly. The conclusion is the way contract modification is accounted for depend on whether the modification increases scope with the distinct goods or services, or whether the price reflects the stand-alone selling prices of the new goods or services. So if the modification does not meet these criteria, means if there's the goods or services are not distinct and the price not reflecting the standalone selling prices, then you will treat that transition maybe a termination of the original contract or is a part of the original contract. So if the goods are not distinct and the remaining goods or services are not distinct, then you will treat as a part of the original contract. Now if the remaining goods or services are distinct, then you will treat as a termination of the original contract and creation of new contract. If the goods or services are distinct and that reflect the stand-alone selling price, then that will be treated as a separate contract. Clear? So accounted, let me zoom in here. So accounting for modification where remaining goods or services are not distinct. So in the scenario, construction company modify an existing contract and the contract a commercially bidding, but modification does not create distinct goods or services. This means that the modification is treated as a part of original contract and the company need to be accounted for as a change accordingly. So the key point in this topic is that when you have modification is a part of original contract, then what you will do, that first you have to clear it that the remaining goods or services you are receiving after modification are not distinct. So when they are not distinct, Then from those before modification, the modification will be treated as a part of original performance obligation, and the performance obligation is remain the same because the modification does not enter. So this is actually the thing which we have already discussed. Now here we have example. Okay, so we have a question here that okay, 1 minute, that discuss with a calculation. Okay, so here we have a question that is discuss with a calculation how much revenue should be recognized in relation to the above at the reporting date, and then discuss with a calculation how the revenue should be recognized in relation to the above by reporting date at the contract specified price is this one for the additional product. Assume that the normal standard selling price is modification is this one. Clear? Okay, the question is Salty enter into a contract to supply 1000 product to Sweet, and the amount is this one. Now the product are transferred over 8-month period and the control cost on delivery. Now after Salty has transferred 700 product of the contract is modified to require additional 200 product to be transferred. The price of the additional 200 product is 57, which is the stand-alone selling price at the date of the contract modification. By the reporting date, the Salty has transferred 900 in total to the Sweet. So, if you see here in this scenario, supply of 1000 product, the price is 60. Now the product to be transferred, transfer. Now they have transferred 700. 700 product has been transferred at the rate of 60. And this time, after transferring 700, they have modified the contract for the additional 200 products. This means that the scope has increased and the price of additional product is 57. This means that is also the increase in price also reflecting the stand-alone selling prices. You know, the company Salty in the first scenario, I will talk about the first scenario that the price of the additional 200 product is $57, which equal to the stand-alone selling price. So this meet the criteria of separate contract because the scope is also increased, and the additional product is distinct product, and the price is reflecting the stand-alone selling prices. So this contract should be treated as a new contract. So I mean the original contract is 1000 unit at a $60 and the new contract of 200 unit at 57. Okay, so actually they have transferred 900 products. So when 900 multiplied with $60, so you will have 54,000 revenue at the reporting date. Now, if you look at the second scenario says that the specified price is 40. So, the price of the additional 200 product is $40, which does not reflect the stand-alone selling price, which is 57. So this does not qualify as a separate contract because the price does not reflect the stand-alone selling price. But the additional goods or services are distinct, so we will treat this contract as the termination of the existing contract and the creation of new contract. Okay, so revenue under original contract. The revenue under original contract under original contract will be 700 as already transferred and the price was 60, so that will be 42,000. Now the termination of the original and the creation of new contract, so the new transaction price will be unrecognized consideration plus the additional consideration. Okay, there are 1000 product contract, but you have already recognized 700, so means the remaining 300 is not recognized with the rate of 60, and the additional is 200. You see here in the question that they are requesting for 200. If you see here, the additional 200 product to be transferred at the rate of 57, sorry, 40. So this is the 40. Now if you multiply this, then you will get 18,000 plus, and this you will get 8,000. So the amount will be 26,000. Okay, now the new transaction price will applies to the 500 product. Okay, this 500 include 300 from the original and 200 from the new contract. Clear? So if you want to calculate the revenue per product after modification, revenue per product after modification, then you'll just have to divide this new transaction price with the remaining units, and then you will get 52 per product. This is the price after revised price after modification. Clear? Now after modification, revenue will be 200 multiplied with a 52. So you will have this amount, and you know that the total amount transferred is 900. Okay, and this 900 you have already recognized 700, and now you have to recognize 200 more. So for this you have calculated as 42,000, and for this you have calculated this amount. So the total revenue should be recognized at the reporting date will be 52,400. Okay, hope you guys understand this this question and also this topic. This is very interesting, and you must also understand the concept of standalone selling prices. That what does we mean by the standalone selling prices? Is usually the price at which the company would sell a good or services separately to a customer. So it represents the value of the good or services on its own in a transaction without bundling it with the other good or services. And for that, there's a key characteristic of the standalone selling prices is that is a market-based price, which means that reflect the fair value of the goods or services absorbed independently in the market. And then observable data, when possible, it is derived from the actual price data from a similar transaction, estimated if not directly observable. And then we have discussed that if the contract is there is a change in the price and the scope in the contract, then we call this modification a contract, and you will get a 3 scenarios: separate contract, termination of original contract, and creation of new contract, and a part of original contract. So this is the very interesting and very basic. You have to understand this. Okay, thank you for watching.